US stocks surged. You've seen the numbers. We've shown them to you. Over 3%. Check where they are now just at the moment, and you'll see the economy. The adding of 2.5 million jobs gave a boost. 3.25% seems to be where the market is happy to be at the moment. We're over 27,000. Bear in mind, the all-time high is only 29,000. The lockdown was 23,000. Now, it's risen 7% over the past week, despite social unrest, despite coronavirus and US-China trade tensions. David Kelly is with me, Chief Global Strategist at JP Morgan Asset Management. You join me now. David, now, I know things are looking better, but this market is what I describe, I think I've seen others write about, it's FOMO now, isn't it? Fear of missing out. The market is heading back towards its all-time high, seemingly at a fair old clip. Tell me about it.
Well, it does seem to that, or you could say it's Tina, because there is no alternative. Because what's happening is there's a lot of liquidity in financial markets has been poured into financial markets by the Federal Reserve. But if you look at long-term interest rates at below 1%, that's not really a good long-term investment at this point. You can't make any money on a savings account. And so that is funneling money towards the equity market. And I think what we're seeing is we're sort of building a ladder of rationalization around this bounce back in jobs and signs that things might be getting a little bit better. I mean, they are getting a little bit better, and that's good, but it's a little bit. I mean, it's a little bit like you fall off a cliff and you land on a trampoline, and the bounce is impressive, but I think the fall is really more important here, and we seem to be missing that.
Well, yeah, but that's one of those interesting things. Does it matter that we may be missing it if investors believe, excuse me, if investors believe that this is the way forward? Does it matter?
Yes, it does matter, because in the short run, markets are driven by emotion. In the long run, they are determined by economic fundamentals. And it's good to see that the bottom of this recession wasn't as bad as it might have been in terms of unemployment. I think unemployment will slowly come down from here, but our models are still saying we'll probably have double-digit unemployment going into next year. And because there's a lot of low-wage workers and a lot of industries which are just going to find it hard to come back here in a fast way. So we're going to be dealing with a lot of problems for a while here. And I think the market is a little bit ahead of itself here. And then you get a correction. I mean, what's a correction? It's when the market realizes it got ahead of itself. So the fact that the market's gone up this much shouldn't mean that we shouldn't feel complacent about this. I think it's important to be diversified, important to recognize there's still some problems out there which could cause a market correction.
Right. Yeah. Okay. The problems, of course, of earnings and the strategy for going forward of a diverse portfolio. But as bonds continue to be in the doldrums, this does hinge, as you rightly say, on this search for yield. And I wonder whether search for yield eventually increases risks to unsustainable levels.
Well, it does. And what we're in right now, and we've been in this for a while, but it's pretty extreme right now, is we're in a low interest rate, low inflation environment with high asset prices. If you've got a portfolio, you're trying to find income, how do you want to do that? The right way to do that, I think, in many cases, is have a total return strategy, sell a little principal. There's nothing wrong with it. Sell, if you've got some stocks which have gone up a lot, sell a little bit of that, make your own income, but don't say you can only get income from coupons and dividends and then go out on the risk spectrum trying to find the highest yielding bonds, the highest yielding stocks. I think that is dangerous. So I think when you've got very low interest rates, low inflation, think about a strategy where you sell some principal to generate income rather than just looking for the highest yields you can find.
I understood, but it's very difficult. I mean, look, I found it with myself in my own sort of portfolio. It's very difficult not to think, hang on, this gravy train is leaving the station, accepting all you've said about all the hardships that still exist and the people being left out. But this gravy train is leaving the station, and I'm at risk of not being on board.
Well, you should be on board the train for the long run anyway, and I think it's so important to have a long-term strategy. This has been a crazy year, perhaps the craziest year we can remember, in modern history. And the market has swung pretty wildly. And you're not supposed to be able to time every part of this. But ask yourself, when you buy an investment, is this a good investment? Will I look back 5 years from now, 10 years from now, and say, that was a good investment? And one of the problems right now is when you look at long-term bonds, given the amount of stimulus in the economy, I think we'll eventually see somewhat higher inflation. If we do that, we're going to see somewhat higher interest rates. And you can't make money in bonds if you start below 1% and rates rise. So I think that is pushing money towards equities. But I think you've got to be careful here. Make sure you're being logical about this. It's not about how you feel. It's about how you think. That's how you make money in the long run.
Logic. Now, there's a word we don't often hear too often, but I'm grateful you brought a bit of logic to our proceedings today. David, have a good weekend, sir. I appreciate it, as always. So thank you. Now.